Good morning, I'm Maiki Oreta, and this is Business 360, from markets to policy, from Manila to the world. We cut through the noise so you can navigate, adapt, and lead in a changing economy. A rare bright spot, Philippine business activity surges to a 7-month high. But does one strong number mean the economy is turning? Forecasts hold, but confidence doesn't. BMI research keeps a 5.2% growth call for 2026, even as weak 2025 momentum casts a long shadow. The government hits the gas. 1.44 trillion pesos in first quarter spending is unleashed. Can catch up budgeting still save growth? The central bank is taking a harder look. A deeper fourth quarter slowdown forces a reset and keeps rate cuts very much in play. And later, a breakthrough beyond the numbers, a 3D printed breast tissue innovation offering not just treatment, but dignity and hope for cancer survivors. After months on edge, Philippine factories start 2026 with a clear shift as stronger demand pushes activity to a 9-month high. S&P Global survey of about 400 firms shows the Philippines' Purchasing Managers Index jumping to 52.9 in January, a sharp climb from 50.2 in December. This is the strongest improvement in operating conditions since April of 2025, when the index reached 53. The reading now sits firmly above 50, the line between expansion and contraction, after months of stalled momentum, including a 4-year low of 47.4 in November. S&P Global says new orders are accelerating, partly driven by renewed export demand, pulling production back into expansion for the first time in 5 months. It's an early positive signal for the industry, jobs, and trade. The key question now is, can demand sustain it? Now, the economy enters 2026 under clear strain after late 2025 growth falls short of both government targets and market expectations. BMI, a unit of the Fitch Group, maintains a 5.2% growth forecast for 2026, but warns that risks are tilted to the downside, pointing to delays in infrastructure spending. Official data shows that the economy grew just 3% in the fourth quarter of 2025, dragging full-year growth to 4.4%, well below the Marcos administration's target. Bangko Sentral Governor Eli Remolona Jr. says momentum could improve in the second half as the central bank considers additional support, with Deutsche Bank saying a rate cut is almost certainly on the table. The Cignal, a slow start to the year with policy, execution, and confidence now critical to stabilizing growth and jobs. With growth losing momentum last year, the government moves early, accelerating spending to reset the economic trajectory in 2026. Finance Secretary Frederick Go says 1.4 trillion pesos will be disbursed in the first quarter, drawn from the 6.8 trillion peso national budget, as the government targets 5 to 6% GDP growth. Go says governance reforms, transparency, and focus on high multiplier projects are meant to shore up investor confidence without compromising fiscal discipline. He also confirms the Philippines is pursuing bilateral partnerships on nuclear energy, including small modular reactors to bring down electricity costs and scale up clean power. This marks a policy-driven bet that faster spending and lower energy costs can help steady growth, confidence, and job creation this year. As economic growth loses momentum, the case builds for another rate cut by the Bangko Sentral ng Pilipinas. Governor Eli Remolona Jr. says fourth quarter GDP expanded just 3% weaker than expected, prompting a review of the central bank's 2026 outlook. He emphasizes that any policy move will remain data-dependent, with inflation, demand, and supply conditions guiding both the timing and the scale of any cut. Deutsche Bank and Citi economists say that the soft growth print strengthens the argument for another rate cut, with economic recovery still expected to gain traction in the second half of the year. The message, slower growth, is shifting the policy balance. and additional monetary support could arrive soon, lowering borrowing costs and helping steady spending and investment. The Philippines' repurchase agreement, or repo market, is gaining speed and could overtake foreign exchange swaps as early as this year. That as the central bank pushes deeper financial market development. Bangko Sentral Governor Eli Remolona Jr. says repo transactions have reached 100 billion pesos, now making it the second largest market after FX swaps. He adds that growth is strong enough that repo could eventually make FX swaps less relevant. Remolona also points to broader market depth with 30 billion pesos in transactions since the peso interest rate swap market launched in November of 2024. The SP Deputy Governor, Zeno Ronald Abejona, says that rising activity is improving liquidity, aligning market rates, and strengthening the transmission of monetary policy. The implication, a more mature, better connected financial system supporting stability, investment, and making central bank policy more effective. The Philippines is moving to turn its 2026 ASEAN chairmanship into real economic leverage, with President Ferdinand Marcos Jr. calling on government agencies to deliver jobs, business growth, and digital expansion. Marcos says that the chairmanship must put people-first programs front and center, ensuring regional leadership translates into tangible benefits here at home. He urges agencies to align national priorities with ASEAN's agenda, positioning the Philippines to capture gains while strengthening cooperation across Southeast Asia. The president also underscores development support for the Bangsamoro region, calling it a key focus area ahead of upcoming BIMP IJEA activities. Our ASEAN leadership is being framed as an economic opportunity for job creation, stronger small businesses, and a more competitive digital economy for Filipinos. Multi-billion peso infrastructure projects are at a standstill, and President Marcos is ordering government agencies to release payments to contractors immediately as corruption controversies and a slowing economy weigh on confidence. Presidential Communications Undersecretary Claire Castro says that the president is demanding faster project execution and stricter oversight to ensure public funds translate into real results and contractors are held to account. The directive comes after economic growth slowed to 4.4% in 2025, with investment and public works hit hard by multi-billion peso flood control irregularities. Marcos is also ordering cabinet secretaries to accelerate reforms and tighten project monitoring as the Department of Justice pursues alleged plunder cases against former officials and contractors. The goal, unblock government spending, restore credibility in public projects, and keep infrastructure investments moving at a time when the economy can least afford delays. The Bangko Sentral ng Pilipinas is moving to open up the financial system to third-party digital products while drawing a clear line against online gambling. The central bank is set to issue new rules for digital marketplaces, allowing banks and e-money issuers to offer financial products from third-party providers, including insurance companies. The SP Deputy Governor Lynn Javier says that the circular is now in its final review. She says that the rules will explicitly prohibit any products linked to online gambling. At the same time, the Bangko Sentral is updating its bank assurance framework, allowing banks to partner with insurers outside their own financial groups. The goal? To expand insurance access, particularly in underserved and underinsured areas. The central bank expects the digital marketplace regulations to be issued in the first half of 2026. Now, the Cignal, a more open and competitive digital financial system with stronger consumer safeguards, a hard ban on gambling-linked products, and broader access to insurance for Filipinos. We're taking a quick break. More news and the context behind it when we return. This is Business 360. Today, we take a hard look at where the Philippine economy stands, from slowing growth and investment pressures to the policy choices that will shape 2026, with confidence, capital flows, and interest rates all in focus. The key question is how much room the economy really has to recover and what needs to go right for that to happen. Joining us now with his insights is former Deputy Governor of the Bangko Sentral ng Pilipinas, Diwa Gunigundo. Hi, sir. Good morning, and thank you for being here with us.
Hi, good morning, Mikey, and thank you for this kind invitation.
Yeah, always good to hear from you. Sir, let's get straight to it. Finance Secretary, Dec Go, says that the latest growth numbers are, quote, not a disaster, pointing to still intact macroeconomic fundamentals. Do you agree with him? What do you think the numbers say to you?
Well, I share the view of Secretary Go. I believe he knows the problem, and he has some idea on how to address this problem of decelerating growth. Those pronouncements about new trade agreements, joint ventures, reducing the cost of power, and addressing issues about logistics, and even those pronouncements by the monetary authorities with regard to deepening and broadening, the digital platform, increasing the depth of the capital markets. I think those are all positive for both investment and production.
Yeah.
However, one can still argue that the the fourth quarter, and the entire 2025 growth numbers could still be described as disastrous. Disastrous for the reasons that one, both the fourth quarter and the whole year of 2025 numbers are way below the official targets of at the beginning 6 to 7%, and then later on the targets were reduced to 5.5 to 6.5%. And we know what happened. The last quarter of the year went down by 3%, and the entire year yielded a growth rate of 4.4%. So it's way below
Yes, way
the
below, way
expectation.
below. And sir,
Yeah.
when our finance secretary says that these figures, these decelerating 2 quarters at 3.9 and at 3% in Q4, when they say it's not a disaster, do you think that perhaps they're downplaying the severity of the weak growth figures, given that they're so far from expectations and from the government's own targets?
I believe that Secretary Go wants to put that into context because of those policy pronouncements that there is still space for saving the economy, for allowing the economy to grow close to its potential capacity of between 5 to 6%. But the actual numbers, as we said, Mikey, was actually way below the actual expectations for both the third and the fourth quarter and the entire year of 2020, 2025. Again, the reasons are structural. One is household consumption. Household consumption actually decelerated, no, from 4.9 to 4.6%, even as inflation was almost half from 3.2 to 1.7%, precisely because absolute prices are still very
Elevated.
elevated. And high prices are reflective of structural issues or structural problems, production issues, distribution, logistics, cost of doing business. These are structural issues. Second, of course, is private investment. Private investment actually declined, no, from 7.7 to 2.1%, minus 2.1%. Again, this is an issue of uh, high cost of doing business, not
Yeah.
only because of the high cost of power, but also it's also reflective of the erosion of both public and business confidence in the economy's not only trajectory but also in politics. We know what happened since last year about these flood control anomalies,
Yeah.
and their implications on the rule of law, justice system, and is the government up to protecting private contracts
Yeah.
and similar issues about predictability of public policy. And
From your
that is
experience,
something that
sir.
is structural.
Yeah. From your experience, sir, with the central bank, we've got the weak GDP figures. We've got the debt to GDP ratio at about 63.1%. FDI is down 40%. But at the same time, latest data, PMI up 52.9% in January. What does all of this data tell you as a former central banker?
It means that the macroeconomic situation is not getting any better, but it is getting worse. Okay, you see, GDP is decelerating, so it means that the economic pie, so to speak, is getting smaller, and you know the labor market is also reflective of that. Unemployment and underemployment are both going up, which means that the opportunities, no, the job opportunities and the opportunities for more decent livelihood for many of our people, especially those in the peripheries, no, and the margins, are not getting any brighter. Okay?
Yeah.
At the same time, the government needs to spend and spend more efficiently and effectively. But the problem is we have issues about corruption and bad governance. And as a result, you have seen how the deficit has continued beyond 1 to 2 trillion pesos every year. And this is one of the major problems and major issues that drive higher indebtedness on the part of the national government. I think at the end of October or November, the latest number would indicate national government debt of about 17.6 trillion pesos, which is about, as you quoted, Mikey, 63.1% of GDP.
Okay.
And if you compare that before the pandemic, the number was only 7.7 trillion or only 39.6%. So it's a big jump from before the pandemic up to this point. We should be getting less and less of our national government debt, so that more public resources can be channeled to infrastructure, public health, and public education, just to name a few.
Yeah, I wanted to bring a trend into context. Given our weak GDP figures and our rising population, I mean, the Philippines, we've been in this OFW era for a while. And I
In the
want to talk about
1970s.
and I want to talk about the trajectory, because with a low growth and the high population, does that mean that we're going to be exporting our talent for the next couple of decades? Because when you look at it, our population is projected to reach nearly 124 million by 2035, adding almost 15 million people since 2020. And if growth stays at these levels, at these current levels, what does that mean for job creation over the next decade?
Unless we're able to strengthen our economy, one that is accelerating rather than decelerating, one that is sustainable, one that is enduring, and one that is more inclusive. In other words, more jobs are available, prices are more stable and low, and basic goods are accessible to the general public, especially the poorer segments of the population. OFW or overseas jobs would always be the default rather than a choice. Well, that means that the economy will continue to spend more on the training of our people, investing in our human capital, only for these young people to go abroad. So foreign countries are actually taking advantage, reaping the returns on our human capital investment. That is not a good way to grow,
Yeah.
Mikey.
Yeah, that's
We have
right.
to, we really have to overhaul the Philippine economy and get our act together, so that more people will get more quality jobs, and overseas jobs will no longer be the default solution, but it's a choice among our people. But the problem is, it's a default rather than a choice among our young people, especially those who were
Yeah.
trying to be doctors and accountants and nurses.
It's a default because they don't have the opportunities that they should have here. Moving
Yeah.
forward,
And
yeah,
that is reflective, Mikey, of one, underinvestment, two, weak productivity growth, and number three, limited upward mobility here in the Philippines.
yeah. You know,
Those are structural.
so much of our national budget this year, because people are afraid to put it in infrastructure. It's going towards investments in human capital like education, and
Yeah.
these are great things. But when you look at our economy and the fact that we're educating to export our talent, what does it say about the pickle that we are in? I mean, our investments in human capital are going towards benefiting perhaps other nations as we export our talent. What are your thoughts on this?
Precisely. If we recall, the overseas employment was a stopgap measure in the 1970s because at that time, we wanted to go into labor-intensive kind of production. That was in the 1970s, part of the Gustav Reines report, no? Courtesy of the International Labor Organization or the ILO. But that stopgap measure was institutionalized into a significant public policy pillar. That should have been a temporary stopgap solution at the time that we have yet to develop, nurture, and institutionalize our ability to train our people and produce a stronger economy. So that, as I said, going abroad will only be an option or a
Yeah.
choice rather than a default option by
That's
our
right.
people.
That's right.
Yes,
You know, OFW remittances are a key pillar. In 2024, inflows were at 38.34 billion US dollars. That's roughly
that's right.
8.3% of our GDP. What can the private sector do? We have these problems. The government is aware of them. What can the private sector do to step in to make money while also addressing these structural issues in the country?
Well, as far as I'm concerned, I think our private sector can continue to invest and produce here in the Philippines. For those who invest, they can do so and concentrate on those industries where risk is relatively manageable, returns are decent, and the prospects of growth are much better than the rest. That's one. Two, most of our private sector investors and producers should also try and participate in human capital development. I think we must invest in human capital. I think in the 1970s and the 1980s, we had these industry boards where both the public and the private sectors cooperated in terms of doing training for the employees and making sure that there is a job, there's a match of jobs between supply and demand. The private sector invests, spends on the human capital training. The government also provides the incentives for this type of spending by the private sector. I think that kind of partnership between the government and the private sector should continue. That is how the National Manpower Youth Council came about with its idea of the industry board. And that's also the reason how TESDA, Technical Education and Skills Development Authority, came about precisely to make sure that skills, supply, and demand are matched. And therefore, investment in human capital is not wasted, but it is harnessed to produce more and produce efficiently and productively.
And what needs to change so that our economy, so that the country doesn't, we don't do this deja vu again, massive systemic corruption, stalling public government spending, hurting business confidence. What are the big things that would need to change so that we don't end up in this cycle again?
Again, I will repeat myself. I write a column, and in those columns in business world, we always cite issues about governance. I think if we can get governance right, avoiding corruption, making sure that we adhere to accounting, auditing rules, and make sure that all government contracts are on the level. I think that is one good way of ensuring that investment will continue in the Philippines and continue to be strong. That's one. Second, I think the government should show visible, irreversible execution of both investment and other types of public policy. We don't need new pledges or new roadmaps, Mikey, but we need projects actually approved, contracts that are signed, and timelines met. In short, we need to make sure that the promises of public policy survive contacts with reality.
Yeah. Right, and then this administration has 2.5 years left to
That's
really
right.
help boost growth. I want to ask you, sir, the BSP, the Bangko Sentral's Monetary Board, which you're very familiar with, will be meeting on February 19th to talk about interest rates. People are saying because of the weak GDP figures, Q4 and full year 2025, that the door is open for more rate cuts. But at this junction, the BSP has already done so much on that end. The policy rate is now at 4.5%. That's roughly 200 basis points worth of easing since August of 2024. They've been very supportive of growth, but are they close to their limits when it comes to monetary policy? Because that's just one aspect of the equation. What are your thoughts on this, sir?
Well, my personal view is that further easing would be justified if, one, inflation expectations are firmly anchored. And I think it is.
And they
firmly
are,
anchored.
yeah.
Okay? Second, global financial conditions are stable, but they are not. Okay? There's so much uncertainty in the market. Geoeconomic fragmentation is very much felt by the various economies of the world, especially the big ones. And number three, growth continues to undershoot its potential level, and it is with 4.4, 5%. Definitely, that is below our potential. But our potential has been coming down precisely because of underinvestment, precisely because of issues about governance, about where public money is going. Okay, so for me, the issue of monetary policy continuing to be biased towards easing may be losing credibility precisely because there are other structural issues involved in ensuring and nurturing economic growth. Monetary policy is just one of those pillars. Monetary policy is just one of those things that can incentivize economic growth. But if we continue to ease monetary policy, we might also be risking financial instability. When there is little a narrowing of differential between domestic and U.S. interest rates. The problem is we might be abetting capital outflows,
Yeah.
and therefore a possible weakening of the Philippine peso.
Yes, that's right, sir.
Weakening of the Philippine peso may not be bothersome, or it may not be concerning. However, if it continues to weaken over a prolonged period of time, even inflation expectations may be disanchored. And when that happens, I think the monetary board will have to pause and buy time and consider all of these balls of these many balls in the air.
Yeah.
Monetary policy might be pushing
A
on a
lot to
string.
juggle, yes. In terms of the peso has been flirting with the 59 to the 60 level. That said, do you think it would be prudent for the central bank to pause at this junction?
Well, since last year, I have been saying this, Mikey, it is best for the central bank to pause and review all of this macroeconomic developments, especially the issue of capital flows, the issue of the exchange rate, and whether the movement of the peso might contribute into disanchoring inflation expectations. Right now, inflation expectations seem to be well anchored. However, there are limits to how much monetary policy can do.
Yeah. That said, sir, where do you think the peso is headed this first half of 2026?
Very difficult to say, Mikey, because there are so many unknowns.
Yeah.
In fact, we don't know those unknowns basically. But for me, it could be between 59 to 60, depending on how the government is also able to address those structural issues, communicate to the market that it is serious in ensuring strong, inclusive, and sustainable economic growth, addressing those structural issues, making sure that
Yeah.
this issue of corruption and bad governance are addressed decisively, and that means public and business confidence might be restored,
Yeah, and
and it's a plus to economic growth.
Yeah, and the weakening of the peso, that's going to, it could be inflationary. Okay, last couple of minutes, sir. Let's just do a
Yeah.
really quick fire round. Okay, I'm going to ask you a question and just give your whatever comes to mind. Say that. Okay, fill in the blank. The Philippine economy improves meaningfully when blank changes.
Policy execution and governance.
Okay, one word to describe our uneven economy right now.
Uninspiring.
Ooh, okay. Biggest risk in 2026.
Those political noises, impeachment, for instance.
Yeah. Okay. First signal you'd watch to know that we're at a turning point, that our economy is starting to get better.
Well, of course, we always look at GDP, but GDP suffers from about a quarter lag. So I would rather go and see and watch what happens to the Purchasing Managers Index, or PMI, as well as what's happening in the labor market.
Okay, well, we saw a bright spot with the latest PMI data. Hopefully that continues. Okay, if you had to choose, protect the peso or push growth, what would it be?
Push growth, definitely.
Okay, and despite everything, sir, last question, what gives you hope?
Our people are tenacious. And I think we have a workable plan. All that it needs is the decisive, good leadership, one with integrity, one with the love of country.
Okay, and that's what we're all hoping for. Thank you so much for your time, Sir Diwa Gunigundo, former central banker.
Okay, thank you very much, Mikey.
Okay, please stay with us. More business stories and the signals behind them when Business 360 continues. Welcome back. The Philippines is seeking billions of dollars from the World Bank as infrastructure gaps and climate risks intensify. The government is pushing for new financing to upgrade water, sanitation, and solid waste management systems across the country. One key project is the Philippines' Accelerated Water and Sanitation Project, designed to expand access to safely manage water and sanitation services. The program also aims to improve the operational performance of water service providers, particularly at the local level. Total project cost exceeded $268 million. At the same time, the Philippines is seeking more than $1 billion in additional World Bank financing to strengthen solid waste management systems and cut plastic pollution. The World Bank warns that the country faces deep-rooted waste management challenges, pointing to rising waste volumes, limited barangay-level capacity, and chronic funding shortages. The funding push highlights the growing strain on basic infrastructure as population growth, urbanization, and climate risks outpace local resources. For the government, turning to the World Bank is not just about financing. It's a test of execution, governance, and whether large-scale projects can be delivered effectively on the ground. On another front, Metro Manila is showing signs of a condominium glut with thousands of completed units sitting empty, even as pre-selling demand remains relatively strong. Colliers projects residential vacancy to rise to 25% in 2026. The increase is being driven by a buildup of inventory in the mid and lower mid-income segments. Vacancy is expected to peak in 2026 before easing slightly to 23.9% in 2027, suggesting oversupply pressures will persist across key residential hubs. Metro Manila currently has around 30,000 unsold, ready for occupancy units. Many owners are struggling to resell or lease their units once projects are completed, slowing overall market absorption. Despite continued pre-selling activity, developers are being urged to shift greater focus to ready-to-occupy inventory. Recommendations include more flexible payment terms and a tighter focus on high-performing submarkets to clear excess supply. The condominium market is sending a mixed signal. Demand at the pre-selling stage remains, but oversupply in completed units is dragging on absorption. For developers, that means adjusting strategy from pricing and incentives to where and what they build next. Now, in other news, local dairy production hits a new record. Philippine dairy output rose 12% year-on-year to 43.3 million liters in 2025, up from 38.6 million liters in 2024. That is the highest level ever recorded according to government data. The National Dairy Authority says that the growth is driven by programs that improve animal nutrition, expand local herds, and strengthen farm and animal management practices. Notably, the gains were achieved without importing dairy animals, showing productivity gains from local development rather than expansion by imports. Milk output from Carabao, cattle, and goats posted strong increases. Support from the Philippine Carabao Center and the National Dairy Authority played a key role. Despite the improvement, the Philippines still imports most of its dairy products, but higher local output brings the country closer to the government's target of 5% milk self-sufficiency by 2028. For the economy, this means greater support for local dairy farmers, stronger rural livelihoods, and a gradual reduction in dependence on imported dairy. Now, the Philippines remains the world's second largest pineapple exporter and the top supplier in Asia. For the third consecutive year, the country ranks just behind Costa Rica in global pineapple exports. Strong government and industry support combined with supply shortages in Costa Rica helped lift Philippine shipments. Preliminary data for 2025 shows exports of 14%, reaching more than 775,000 metric tons. China, Japan, and South Korea remain the Philippines' largest markets. Steady demand from these key buyers continues to strengthen the country's position in the global pineapple trade. For the economy, this means stronger export revenues and a higher profile for Philippine agriculture on the global stage. Now, Filipinos are feeling the pinch of high interest rates, and it's changing how they spend, save, and invest. On BNC's Business Brief, John Paulo Rivera, Senior Research Fellow at the Philippine Institute for Development Studies, says elevated rates are pushing consumers to save more and hold back on spending. That shift, he says, is dampening demand across the broader economy.
Well, let's talk about the consumers. The higher the interest rates are, then there is more incentive for our consumers to actually put their money in the bank rather than actually spending. So higher interest rates actually controls spending. For businesses and investors, so because interest rates are high, then the cost of borrowing money to finance their operations would also be high. So they would tend to be very careful, very cautious about borrowing because of the high interest rate environment.
Rivera warns that prolonged high interest rates do not hit all sectors equally. Construction and real estate are among the hardest hit, with projects delayed and investors taking a more cautious approach. The result, slower momentum in property and infrastructure. Consumers may be saving more, but until borrowing costs ease more, business investment is likely to remain under pressure in the months ahead. Now, the Philippine stock market is reeling after sharp losses in companies linked to billionaire Manny Villar. Villar Land plunges 28.5%, Vista Land falls 15.25%. All Home slides nearly 14% in a single session. Investors wiped out an estimated $1.2 billion from Villar's Forbes net worth. The Securities and Exchange Commission has filed a criminal complaint against Villar and several of his companies. The case alleges market manipulation and insider trading claims that have yet to be resolved in court. The sell-off spreads to the family's real estate investment trusts. Vista REIT and Premier Island Power REIT both dropped by double digits. For Villar, this is more than a legal challenge. The market reaction deals a direct hit to investor confidence in the group that underpins his business empire. The message from the markets is clear. Confidence is built on transparency and corporate accountability. As the case unfolds, investors are watching closely. In other news, Bank of the Philippine Islands reports higher earnings in 2025 with loan growth and stronger revenue offsetting rising costs. Total loans reached 2.6 trillion pesos for the year. The Ayala-led bank posted net income of 66.6 billion pesos, up 7.4% from a year earlier. Total revenues rose 14.8% to 195.3 billion pesos, driven by higher interest income, card and insurance fees, and trading gains. Cost pressures remain. Provisions and operating expenses both increased during the year. Asset quality, however, held steady. Non-performing loans stood at 2.2%. The cost-to-income ratio edged lower at 47.2%. The results show the bank earnings remain supported by loan growth and revenue momentum, even as costs and credit risks stay in focus for investors. Now, SM Offices, the commercial real estate arm of the SM Group, secured a LEED Gold certification for its 5 e-com center in Pasay City. The 15-story office building becomes the company's 6th LEED certified property in the country. The project is certified under the LEED V4.1 operations and maintenance existing buildings framework, which evaluates energy use, water efficiency, indoor air quality, and building operations. The Twin Towers provide more than 93,000 square meters of leasable office space with average floor plates of around 3,500 square meters, allowing flexible office configurations. The building uses energy monitoring systems and occupancy-based cooling to manage power consumption. Energy recovery ventilators are used to maintain indoor air quality while reducing HVAC load. The site also includes electric vehicle charging, bicycle facilities, and pedestrian links to SM Mall of Asia and to nearby transport connections. Other SM Office projects, including 1 Ecom, 2 Ecom, and the upcoming 6 Ecom, are also seeking LEED certifications. The certification adds to a broader shift in the office market, where developers are increasingly using third-party standards to manage energy costs, meet tenant requirements, and protect long-term asset performance. Up next, global markets, what's moving and why. This is Business 360. Welcome back. The Visayas could see a major addition to its power supply as Vivant Sol Energy Anilao Corporation proposes a 6.2 billion peso hybrid solar power project in Iloilo. The proposal comes as electricity demand in the region continues to rise, and the power sector looks to add new capacity while cutting reliance on fossil fuels. Vivant Sol Energy Anilao is a unit of the Cebu-based Vivant Group, which operates power generation and energy solutions across the country. The Visayas has long faced tight supply conditions, making new, reliable capacity a key issue for the regional grid. Project details show the facility will have a solar capacity of 173 megawatts paired with a 99 megawatt-hour lithium-ion battery energy storage system. The battery component is designed to manage output fluctuations and support grid stability. Construction is expected to take around 12 months, with commercial operations targeted for the fourth quarter of 2027. Power from the project is set to be supplied to core supplier Core Energy Incorporated. The proposal highlights how developers are increasingly combining renewable energy with storage to address intermittency and grid reliability for the Visayas. Now, the project could help ease supply pressures and support a more stable power mix if approved and completed on schedule. Now, a surge in the demand for Pokemon collectibles is triggering a backlash among Jollibee customers as blind box TCG promotions quickly sell out and reappear online at marked up prices. Collectors say, and parents say, scalpers are buying items in bulk, leaving regular customers, including children, with few or no units available at stores. Radio and television host DJ Tony has publicly called on Jollibee to impose purchase limits, saying that the practice of stockpiling undermines the promotion's original intent. Criticism has also been directed at content creators who post about buying multiple boxes, which some fans say has fueled both the scramble and the resale market. The controversy highlights how scalping can distort promotional campaigns and shut out the very audience they were designed to reach. The episode underscores a broader challenge for retailers running high-demand promotions, balancing excitement with fair access. Without clear purchase limits, promotions risk being captured by resellers rather than delivering value to ordinary consumers. Now let's take a look at how global markets moved overnight. Wall Street closed higher on Monday with gains in chipmaker and other companies linked to artificial intelligence lifting the broader market. Smaller stocks also posted strong gains, outperforming large-cap peers. The Russell 2000 jumped with the small-cap index continuing to outperform both the S&P 500 and the Nasdaq so far in 2026. Tech giants Alphabet and Amazon rose ahead of their quarterly earnings reports this week as investors position for fresh signals on the race to dominate artificial intelligence. After the bell, AI-focused firm Planeteer moved higher, while chipmakers including SanDisk, Advanced Micro Devices, and Micron benefited from continued demand for AI-related components.
We are experiencing a bit of a relief rally after what happened on Friday, which was a negative day, but it was a negative day capping off a pretty solid month following a really good year. So I think there's a lot of this give and take in the marketplace. People that are, maybe a little bit more cautious, taking advantage of every opportunity to get and participate a little bit more. And so you're getting people, again, resilient, buying the dips and so forth.
The Dow Jones Industrial Average rose 1.1%, the S&P 500 up by 0.5%, and the Nasdaq higher by 0.6%. Over in Europe, markets also finished in positive territory. London's FTSE and Germany's DAX both climbed more than 1%, while France's CAC 40 rose by 0.7%. Let's check on how Asian markets are doing this Tuesday morning. Right now, everything is trading to the upside except for Hong Kong's Hang Seng Index. The Nikkei 225 is up sharply, up by 3% in early trade. Hong Kong's Hang Seng Index down by 0.4%. Shanghai's Composite up by 0.1%, and Singapore's Straits Times Index up by nearly 1%. Now, taking a look at our market as of 10:49 this morning, the main gauge is also trading to the upside, up by 0.6% to 63.34. The All Shares Index is in the green as well, up by 0.6% to 35.31. Taking a look at all the sub-indices, all are trading in positive territory, led by gains in the mining and oil counter, which is up sharply, up by 5.4%. Total volume stands at 329 million shares, valued at just over 1 billion pesos, 1.22 billion pesos to be exact. Market breadth is very bullish. We've got 108 advancers, 54 decliners, and 61 stocks unchanged. Taking a look at the currency front, the peso opened at almost 58.89 against the dollar, up from its previous close of nearly 58.90. Precious metals are hit by a sharp and sudden sell-off, with gold and silver recording steep losses in just over 2 trading sessions. Gold prices dropped by more than 13%, while silver fell by nearly 34%, one of the most severe short-term moves in years. Analysts say that the decline follows a strong and prolonged rally that left both metals overextended, triggering profit-taking and position unwinding as prices turned lower. The move was amplified by heightened market volatility and a stronger U.S. dollar. Ross Norman, an independent metals analyst, says that the sell-off appears to be a correction rather than a fundamental shift, adding that longer-term drivers such as interest rate expectations, inflation risks, and geopolitical uncertainty remain in place. For investors, the focus now turns to whether prices stabilize after the sharp drop or whether volatility in precious metals continues in the days ahead. Now, Bitcoin investors are hitting the sell button with more than $2.5 billion in positions liquidated over the past few days as risk sentiment turns sharply lower. Data from CoinGlass shows the sell-off coincides with broader weakness across risk assets, including equities and precious metals. Analysts say that the move reflects a shift towards risk-off positioning as investors scale back exposure after Bitcoin slid from record highs above $126,000 to around $105,000. Now, the scale of the liquidation suggests leverage trades were forced out of the market, adding to volatility. Despite the sharp drop, Bitcoin has so far failed to recover its previous peaks, keeping traders on edge. For crypto markets, the message is caution. Until volatility eases and prices find a clear direction, investors are likely to remain defensive, with sentiment tied closely to broader moves in global markets. Now, in other news, losing a breast to cancer can mean losing more than a body part. It can also mean losing confidence and a sense of self. A Colorado-based engineer, Katie Weimer, is working on a technology that could change how breast cancer survivors recover after surgery. Weimer lost her mother to breast cancer at the age of 50. That experience drove her to develop 3D printed breast tissue designed to help patients rebuild their bodies using their own cells rather than permanent implants. In the United States, more than 300,000 women are diagnosed with breast cancer each year. Nearly 40,000 die. Worldwide, there are about 2.3 million new cases annually and more than 670,000 deaths. Even after successful surgery, many patients are left with permanent scarring and limited reconstruction options. Weimer's approach uses bio-friendly 3D printed scaffolds designed to be filled with a patient's own fat cells. The structure provides temporary support, then gradually dissolves, allowing the body to form natural tissue over time. Her startup, Genesis Tissue, launched in 2024. Preliminary lab testing has shown promising results, and the company is preparing for clinical trials, a critical step before the tech can be used in patients. If proven safe and effective, the tech could offer breast cancer survivors a reconstruction option that reduces dependence on traditional implants and their associated risks. For now, it remains in development, but it points to how biomedical engineering is expanding the possibilities for post-cancer care. Now, tourists are braving sub-zero temperatures to see Niagara Falls during a rare winter deep freeze as sections of the waterfall and surrounding landscape turn into an icy spectacle. Visitors are taking in icy cascades, frozen trees, and heavy ice buildup along the river and nearby infrastructure. Photos and videos show large icicles and floating ice flows as extreme cold shows water flow without fully stopping the falls. The scene has drawn both local residents and international tourists, with some marking special occasions despite the freezing conditions. The event highlights how severe winter weather can transform famous landmarks into rare sights, offering a different kind of travel experience, one shaped by extreme cold and natural force. And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo news channel.